Hi all, sorry about that. We've had some technical difficulties, always the fun with technology. So hello everybody that's here. So this is the follow-up webinar on Section 100A, one of the hot topics at the moment. For those of you who don't know me, I'm Kim Barnes and I work in the Sydney office from Brisbane with Adrian, who's also on screen. For anyone who doesn't know Adrian, he is the principal and the head honcho at the Sydney office, and he's going to be leading this topic today. So we received a number of questions on this topic already, which are going to be answered as part of this webinar. So if there's any opportunities at the end to ask questions, we'll take questions at the end and we'll answer any ones that haven't already been dealt with then. There may not be time given how many questions have already come through, but hopefully we can get through any that do pop up. So this webinar is recorded and it's going to be made available on our website following this finishing. And so if there's any questions or anything, just keep the client names out, but we'll be monitoring those as they come through anyway. Before Adrian starts the webinar, I'll just quickly run through some of the features of this sort of platform. If you'd like to download the slides, there's a button there that says Files. And if you click on that, you should be able to download the slides that are appearing on screen. If you can't download these though, they will be made available via email post-completion. There's also going to be a feedback form that we'll send through once the webinar's finished, and that's just an opportunity for you to give feedback, or if you'd like to give us any topics that you'd like for us to address, pop them in there and you might see them in the next webinar that we do. If everyone's sort of in the webinar, I'll hand it over to Adrian and we can get started on this topic.
Thanks for that, Kim, and good morning to everybody. Obviously, we ran the webinar last month on the Division 7A rulings and Section 100A. Had a lot of questions and didn't really get to spend a lot of time on 100A during that presentation, so obviously we thought we'd revisit it. In doing that, I'm not going to really, I'll run through, but I'm not really going to focus on the ATO publications, but just try to have a look at some of the other, I guess, well, I wouldn't call them strategies, but some of the things to consider when we're thinking about 100A, as well as obviously we do have quite a few questions that have come in from the email that was sent out earlier this week asking for questions. So some of those questions actually are in reality some fairly good strategies or things that you might want to consider with clients. So to kick things off, I guess one thing that we really need to consider, and sometimes this is often lost, is, what was 100A introduced for? And to that, we have to go back to the 70s when it was introduced, so a little bit before my time in practice. And the purpose of 100A as it was introduced was to attack or stop what was known in the time as trust stripping. In terms of trust stripping, you had trading in lost trusts, all sorts of things going on in the 70s in terms of tax schemes. So I think you'd probably call the 70s and the 80s really the high point of tax scheming in Australia. So 100A was introduced to address trust stripping, and generally speaking, the reason or what you would use in trust strips were lost trusts or tax-exempt bodies. So with that, one of the examples given a little bit later on in terms of Section 100A is in ATO ID 2005-145, where we had a distribution to a school, which was with the school itself being tax-exempt, such as like a Catholic school, for example. And the distribution was in lieu of fees. So sending a child along to a local Catholic school, instead of paying $10,000 from after tax dollars, you would make a distribution of $10,000 from the trust to pay the school fees. The school doesn't pay any tax. Child gets to go to school. So that's the sort of extension, I guess you'd say. That's not a trust strip in itself, but one of the reasons why 100A was introduced originally. And the reason that we're bringing this up is, if you look at recent cases, they still do work their way through the reason for introduction, as well as obviously the things that have changed since 100A's introduction. We also should refresh ourselves with Section 100A in terms of what the key elements are. So this is extracted from the section. There are quite a number of subsections that we've cut down to what really the main points are of when 100A would apply. Because it is important to remember that just because somebody such as the tax office say 100A might apply, it doesn't mean they've actually necessarily considered the application of the provision to the circumstances. It may be something on a checklist or something they've been told to say. And certainly I've had that experience previously with ATO audits involving trusts, where they've said, oh, we think 100A might apply. When you query them on actually working through the provision as to how it could apply in that circumstance, the answer generally was, we've just been told to say it might apply. So it is important if we're ever in any sort of issue with the tax office and thinking about 100A issues, that we do return to the provision and we do really consider what the elements are. So 100A will operate to deem there to be no present entitlement, where we've had a trustee confer present entitlement. So we've had a beneficiary made presently entitled, which is pursuant to an arrangement that is a key point. It's got to be pursuant to an arrangement. And we'll see the difference in the more recent case of Guardian a little bit later, as opposed to what the tax office say about that in their publications, where there has also been a payment or a benefit provided other than to the beneficiary. So we've made a beneficiary presently entitled. That's been pursuant to an arrangement, but there's been a payment or a benefit provided to somebody else, and that somebody else can include the trustee. And furthermore, that we have a purpose of tax avoidance. I think it's relatively clear that the purpose of tax avoidance could, for example, include trying to avoid Division 7A, but we still have to have that purpose of tax avoidance. So important to remember that, and we'll consider it further when we get into some of the examples and some of the material that the ATO go through. Although it was introduced really for trust stripping schemes and that sort of tax exempt strategy, it's clear in the cases which are a little bit historic now in terms of when they came about, that it's not just limited to a tax exempt strategy or a strategy where we're doing a traditional trust strip. So in Prestige Motors back in 1998, the judgment or the judgment containing the words on the screen there, that there's no reason to think that Section 100A was intended to be restricted to arrangements which provide for the payment of the income to entities not liable to any tax. So clearly, the courts in those decisions and related decisions, such as Idlecroft, took the view that, well, you don't have to have a tax-exempt body or a loss entity involved for 100A to apply. If you have those other four elements, it could still potentially apply. It is also, though, important to remember that in those cases, the sort of strategies that were used by the taxpayers were really extreme. We're not talking about distributing to mum, dad, children, which the tax office are talking about now. We're not talking about distributing to corporate beneficiaries. We're talking about really extreme, artificial to a certain extent strategies that were introduced. So none of those cases ever had reason, and it's certainly reinforced in the recent Guardian decision, that none of those cases ever had reason to consider the concept of ordinary family commercial dealing. And as we'll see, realistically, that's where we're going to be hanging our hat in our normal sort of family situation with UPEs. Sorry, I keep pressing the wrong button to move on. One of the unfortunate things with Section 100A and in reality why it's used as a tactic, I would think, by the tax office a bit in terms of position papers, is that our normal amendment period in the absence of fraud or evasion is going to be 4 years or 2 years. 100A itself has an unlimited amendment period. So that makes it a pretty powerful weapon. And if there is a trust involved, that gives the Commissioner the ability via 100A to go back a long time. So that as I said, that's one of the reasons that they tend to use it, or in my view, they tend to threaten to use it, because they get the unlimited amendment period. Part of that is if they get to the position of actually issuing a position paper, when you run through the calculations of when they say 100A might apply 10 years ago, and you add penalties and interest from that date, the figures just become enormous. And it's certainly something that makes the clients really nervous, as understandably, when they have these position papers with these extremely large potential assessments to be issued. What about UPEs proper, so unpaid present entitlements proper? And in reality, I think that's pretty much why most people have joined the webinar today, to consider what has been done historically, and also consider whether to continue doing it moving forward, and what sort of steps you can take to further protect clients if you choose to do that. No doubt it's common to distribute amongst a family group, whether that's mum, dad, kids, grandparents. Job as advisors is to assist clients to pay the least tax possible. That's not to avoid tax or evade tax, but it's our professional responsibility to ensure that we're giving advice to clients so that they pay the least tax possible. So with that, the reality of that is that unpaid present entitlements tend to accrue if we're distributing amongst family members and we're not actually paying it. The question then comes, well, could 100A apply to that scenario? Without a doubt, anytime we're making a distribution from a discretionary trust and it's not actually being cash flowed and paid, or even sometimes if it has been cash flowed, if there are other things that occur after that, and I'll come back to that because it's covered off in some of the questions that we have later. If it's not cash flowed and it's an unpaid present entitlement, we do need to consider 100A. However, I still think and continue to take the view that there is very strong protection because of the carve out in subsection 13 that says 100A doesn't apply where it's in the course of ordinary family or commercial dealing. And so we'll come back to an analysis of that during the presentation. But that is really, as I said before, where we're going to be hanging our hats, because there's no doubt 100A could apply to any distribution where there's an unpaid present entitlement. But we do have a carve out there, and that's really in a normal family situation. And I know there's no such thing as normal, particularly with families, but in a normal family situation, that's really what we're relying on with 100A. It's always been there. It's always been there since the 70s. It's only just the commissioners decided to try using it these days as a very effective weapon. So moving on to the releases, and as I said, I'm not going to spend a lot of time on these, but try to dwell more on the practical issues. So we had in February, they're still open for comment. We've got the Taxpayer Alert 2022-1, the draft taxation ruling on 100A and what constitutes a reimbursement agreement, and then the practical compliance guideline. So dealing with the Taxpayer Alert, first off, just for the benefit of those that have not have been to a presentation like this before. So the Taxpayer Alert, it talks about a scenario where the situation displays all or most of the following, where we have the trustee or directors of the trustee, corporate trustee are the parents. The income of the trust is used to meet the expenses of the parents, but the children are made presently entitled to income. The entitlements are substantial but don't exceed 180,000. I mean, that 180,000 figure is effectively where we get to, or where we used to get to, where if we distribute more than that, then we pay more than 30 cents in the dollar. Income not paid to children, but paid and applied for paid or applied for the parents. And then the parties contend that the children are required to repay for expenses related to their upbringing, or they're required to repay their parents' costs of living exceeding a reasonable amount, or there's an agreement that the parents will manage the pooled entitlements. Important to remember that taxpayer alerts have come from scenarios where the tax office has identified this in practice in an audit. So this has come from the ATO auditing taxpayers, where the argument that has been raised as part of the defence has been that the children have entered into an understanding that they will repay all of their expenses related to their upbringing. And that is, and no doubt the argument continued on to say, well, that makes it an ordinary family or commercial dealing. Personally, I think that's a pretty flimsy argument, but it's not in itself, in terms of the Taxpayer Alert, a reason to stop distributing to children. It's just more about what are the sort of arguments that the tax office will or will not accept. And clearly here they're saying they won't accept the argument that it's for, in effect, paying for past expenses. So my child is now 18, I'm going to distribute 180,000 to them so they can repay me for school fees for the last 15 years. Certainly not something that the ATO will agree with. And personally, I think I wouldn't take that approach, and I don't think there's a necessity to take that approach in terms of that argument. Taxation Ruling 2022 in draft D1. So it has 4 requirements, or 3 requirements, I should say, for 100A to apply. There has to be a connection, there has to be a benefit, and there has to be a tax reduction purpose. So you can see that is kind of tying back to the elements of the provision. And then they go on to make some comments in relation to ordinary or family commercial dealing exception within the ruling itself. The first sort of 3, I think, are relatively uncontroversial, although there are some issues where they are attempting to downplay or discount the recent decision of Guardian in relation to connection. And but I don't think that's where, in this sort of scenario where we're talking about mum and dad and the family group, we're not going to be bothering arguing about connection or benefit to another. In most instances, we're really going to be talking about ordinary or family or commercial dealing. In the ruling itself, the tax office make a few statements about ordinary dealing, ordinary and family commercial dealing. So they say that agreements entered into the course of ordinary family or commercial dealing are not reimbursement agreements. So if for whatever reason we have an agreement to make somebody presently entitled and we can show that it's in the course of ordinary family or commercial dealing, they won't be reimbursement agreements. And the essential feature of these, according to the tax office, is that it's capable of explanation by familial and or commercial objects they are object to achieve. And I guess that is an important aspect to consider when we're considering these issues, that we've got to show, at some stage, we've got to show the evidence how this is ordinary family commercial dealing, and we'll come back to that. They make the statement that it's not ordinary dealing merely because it is commonplace or involves no artificiality. Take fairly serious issue with that statement. I think even if you, well, not even if, not I think, but if you go to Guardian, there's a comment there from Logan that says ordinary means no artificiality. So the tax office there are trying to have a bit of the best of both worlds there. And they also make the statement that the appearance of tax-driven motives are relevant. Okay, they may be relevant, but that doesn't take it out of the realm, in my view, of ordinary family or commercial dealing. Tax considerations or tax-driven motives are always relevant. They're relevant in every transaction that we do. Just because there is a tax-driven motive does not mean we automatically can't be ordinary family or commercial dealing. Just to, it's not going to help you out much, I don't think, but just to go back to the Commissioner's previous view on what they stated was ordinary family or commercial dealing. That goes back to a fact sheet, and again, a fact sheet is a publication that's not binding on the Commissioner or like a ruling. But in 2014, the Commissioner released a fact sheet trust taxation reimbursement agreement. Has been withdrawn for some time, and you won't find it anywhere on the tax office website, no doubt deliberately. But some people still have copies, like our firm. And so what that says is they accept, and it's uncontroversial, that ordinary family or commercial dealing is not defined within the legislation. So then we have to take it from the ordinary meaning. But in that fact sheet, they do give they made a couple of statements of what they thought was ordinary family or commercial dealing. One was if we distribute and we have a UPE and we retain it in the trust for working capital, they thought at that time that was ordinary family and commercial dealing. Clearly that view has changed. Or if it's lent on ordinary commercial terms. So I said, interesting to revisit this. I wouldn't give it much weight in terms of arguing with the Commissioner and say, well, you said this in 2014, now you're saying this. They'll just say our view has changed. But it does show the knots that they've kind of tried to tie themselves up in, I think, to try and reach a position in relation to the draft publications. The practical compliance guideline, I'm not going to spend really any time on the PCG. You may have read it, you may not have, but in effect, it groups a number of different examples into what different colours: white, green, blue, red. I guess the darker the colour you get, the worse the tax office think you are. I wouldn't give it a lot of weight because the reality is it's a guideline. Doesn't mean that if you're audited, or your client is audited, I should say, and they're in a white zone, that the ATO won't consider or review 100A in relation to them. But in essence, it's saying if you're doing these things, that generally there's no compliance resources. As I said, I wouldn't give it a lot of weight into saying, well, I'm in this position here, I should not think about 100A anymore. Practically, I think regardless whether you're in white, green, blue or red, you should consider 100A and consider how we can better protect clients if there is an audit, and what sort of strategies we could potentially put in place. These publications were all meant to come out last year. That was delayed due to the at the time it had been heard, but the judgment hadn't been delivered in the Guardian case, and so it was a decision of Justice Logan in the federal court. The Commissioner has lodged an appeal, so it will be going to the full federal court. Important to remember in terms of that appeal, appeals can only be on questions of law as opposed to questions of fact. So all of the fact, and if you take the time to read the decision, there's a lot of factual statements and factual scenarios in the Guardian decision that Logan has included in the judgment. All of those are unchangeable. It's now a question of whether the judge erred in applying the law to the fact. So it'd be interesting to see what happens in the full federal court. Of course, any court matter, you never really know what's going to happen. But it was a fairly comprehensive win for the taxpayer at first instance. Commissioner just didn't go after the taxpayer under 100A. There's a second part of the judgment that deals with Part 4A, and the taxpayer was successful on that as well. Couple of important parts of Guardian to consider that I think are directly relevant. And remember, I said earlier, all of the other 100A cases, they never had to consider ordinary or family commercial dealings because these things were so outside the realm in terms of the schemes that were used that no one could ever even possibly try to argue it. So this is our first real decision where a judge in the perspective of 100A has considered ordinary and family and commercial dealing. It's been considered before in terms of other tax aspects, but this is in respect of 100A. Important part that Logan said, the reimbursement agreement must be in existence before the present entitlement arose. So we must have an agreement, whether that's written or implied, before we make somebody presently entitled, which is different to what the tax office take in their publication. They say the agreement doesn't have to be in place, it can arise afterwards. Logan didn't agree, and in one of the years in question, the 2012 year, 100A, as he said, clearly had no application because there was no agreement in place before the present entitlement arose. There was in later years, but at that stage for 2012, was immediately struck out. So that's an important thing to remember, because sometimes, and I've seen this in practice a few times, the tax office will say what you did in, for example, just to pick a year, 2010, was on the basis that there was an agreement that in 2016 you would do something else which would provide the benefit. Clearly, Guardian and the decision of Logan, unless overturned in that respect, shows that that is not the case. You can't have a retrospective agreement, which is what the tax office try to argue sometimes. In terms of that connection basis, that we have to have a connection between the entitlement and the agreement and the tax purpose. Logan goes to say that a connection based on legal or factual hypotheticals is not enough. And what he's talking about there is that as part of the submissions of the commissioner, they said, well, if they hadn't distributed all of this to the company, in this case, there was a distribution to a company, they would have distributed it to the individual. But Logan said, well, this is not about hypotheticals. This is about, was there a reimbursement agreement? Was there present entitlement? Was there a tax avoidance purpose? Was there a benefit provided to somebody else? Simply saying, well, if they didn't do that, they could have done this, and that's where the benefit is, that's not a connection. In Guardian, clearly well, not clearly, but the client, other advisors, including his accountant and his son, were considered to be excellent witnesses by Logan in terms of what they had done and the documentation. And part of their argument was that this was ordinary family and commercial dealing because it was all part of risk minimisation as the client moved to retirement. And the reality that they didn't want to risk the funds that they had accumulated now that he was moving into retirement and would not be generating any more funds. There were also some issues in terms of his sons, which was brought up in the evidence in terms of making sure that they were looked after, so that family wealth type scenario. But very good evidence, and as I said, very strong factual evidence in there about why they took the steps that they did. So I think that's, you know, I'll say it a few times, no doubt, but one of the key things is going to be making sure that we're documenting what our purposes are and what our long-term goals are and what our objectives are, so that if we ever have a 100-day audit, we can go on to show those things as part of the facts that are submitted. Now, if we do have the scenario where we have UPEs, what I call UPEs proper, where we've distributed to children or grandparents or other relatives, or perhaps a company, because we also need to think about that. What are the sort of defences that we could use in terms of that? And there's a few here. You know, the first couple I don't think they're going to get you very far in terms of defence, but one thing that you may want to argue, or may potentially try to argue, is that there's no tax avoidance purpose. And that's based on analysis of Peabody's case and the sort of argument that a trustee, you can't say really where it will distribute the funds, so you can't attribute a tax avoidance purpose to the fact that it didn't distribute it to somebody else. And that was, you know, in terms of that connection requirement in Guardian, that was something that was discussed by Logan. But I think that's a difficult argument to win just on that. You can make an argument that it's not an arrangement. And so I think we've seen, I know we've seen in Guardian that there has to be an arrangement. And so Logan says before the distribution is made. That's going to depend on the facts of the situation. When we talk about arrangement, it's not something like a formal written document. It can be inferred from the facts and the steps that are taken. That's not contentious. And I mean, one of the things that some people that are much smarter than me have suggested is that you can never have an arrangement with a distribution from a trust because that's a unilateral action. And so that can't be an arrangement. I've never been comfortable with that sort of argument. And certainly I think when you think about where you're having something happen year after year, you've got common minds in terms of a family group. I think it's hard to argue that there's not an arrangement. Unless it's something like Guardian, where it was clear because of the facts that the first time the distribution was made, there wasn't an arrangement. They were caught years after in terms of there being an arrangement, but I think it's a difficult thing to argue in a family group. We could argue that we're on commercial terms, not really covered in terms of the Guardian, because it was more about family dealings as opposed to commercial. The discussion in terms of commerciality and risk, of course, but that's a defence if we have that in terms of the factual scenario we have with our client. But as I said, realistically, our main defence in this world is going to be its ordinary family commercial dealing. Any sort of material I've seen from the tax office where they talk about ordinary family dealing, they're relying on fairly historic cases, so cases going back to the 50s, 60s, 70s. Guardian is really the first sort of modern case where we have seen a judge discuss what is ordinary in today's, as in the 2020s, 2010s, world as what's ordinary family dealing. And I think we can certainly put more weight on that than some of the cases that the Commissioner brings up going back 70 years. But they also, in the rulings, downplay Guardian, understandably, I would think. How would we build a case for ordinary family commercial dealing? What sort of things would we want to look to have with our clients so we're putting them in a good position? And I think conceptually, what we need to come back to is that it's not controversial to say that historically, every generation has wanted the next generation to be in a better position, whether that's financially or whether that's via education. You can see that through human history. So the idea that we are managing our affairs so that we are building wealth to pass to the next generation, and we're doing it in a way that we can do it in a tax effective way, certainly fits within that concept and that human tradition, that we want to put the next generation in a better position. It would be very difficult to say that that's not something that an ordinary family would consider when deciding where to distribute income. We want to make sure that we're paying less tax, so we're building our wealth, we're using our funds elsewhere at a better return, so that in the end, we can put our children in a better position. So with that, we should start really looking at, and some of you may already do this as part of, if you have financial planning practices as part of, or financial planning services, but really having a look at documenting our family goals and our family position now and where they want to go to. I'll jump down to a few dot points down there, document the family wealth generation planning. Do we go to the extent of getting a statement of advice from a financial planner in terms of the sorts of things that the family should do to generate wealth and as a long-term goal? We, of course, should also, where we have clients who aren't just your, speaking as one, your stereotypical white person, where there are cultural issues that reinforce our situation, where there's an expectation that we look after grandparents, where there's an expectation that when the grandparents reach their golden years, the next generation look after them. So all of those things should be documented as well if our clients are in those circumstances. If we have a change in circumstances as well, and by that I mean, maybe the children get married, or maybe they move into a de facto relationship, we document that as well, and that may be part of the reason why we do other things in relation to the trust. So again, it's about building that evidence in that case. And when I say document, obviously file notes of meetings with clients are great, but even email exchanges, and a lot of the material that was used in Guardian were email exchanges where we're discussing these sorts of issues. If it's on commercial terms, or we can put it on commercial terms, let's do that, and that will assist. Succession plan, we should, all families should be working to a succession plan, and we should also document, if we can, that we've considered alternatives. And in Guardian, that was part of it as well, that they had considered other options. But if there are other things that we do consider, it's not just the case of talking about them and forgetting about them. We should document them, as I said, file note, email, whatever it is. So those are, without putting extra work on everybody, if we want to be in our best position for looking to defend any sort of 100A action against clients where we've had UPEs, we're going to be relying on ordinary family and commercial dealing. We're going to be wanting to start having this material in our files or on our servers, so that we have these things documented. I guess some other strategy comments as well before we move into the questions. And as I said, some of the questions also include, I guess, kind of strategies as well. So I think it's a pretty good resource to have those questions and those comments. And I thank the people that have submitted them. It's good to share that knowledge and share those ideas. So my first comment, keep it simple, stupid, an old thing I try to live by. The idea being we don't want to really overcomplicate it. And I know I've spent a lot of time just talking about, documenting our reasons for doing things and documenting family goals and wealth generation and all of those sorts of things. But what I'm talking about more in keeping it simple, stupid is if we don't want to be in the position such as the Taxpayer Alert where we're trying to pretend that something is that it isn't. If we haven't documented those other things and we've made distributions to children and we've left them unpaid and at some stage they don't get called up or they do get called up, let's just leave it at that. Let's not go try and go back and recreate the wheel. It's done. Can't avoid it. Can't make it any better. One thing they might want to consider when we're actually cash flowing amounts is to have separate bank accounts for the beneficiaries, and the funds can go into there. I'll have some comments on that in terms of one of the questions a bit later on, but that's also something that we should consider. I mentioned again, considering alternatives, and then also trying to avoid regularity. And so sometimes you see distribution, check paid to the beneficiary, check returned to somebody else, and that happens year after year after year. All matters in tax are looked at in hindsight. Let's try to avoid that sort of regular occurrence or regular forgiveness or gift back. Not so much avoiding the regularity as distributing each year to the same beneficiaries, but more those other sort of steps that can kind of look strange in hindsight. So moving on to the questions, and we do have quite a few. The first one is, if the ALP wins the election, I've read they'll encourage the ATO to apply the trust announcements retrospectively. How do we address trust controller debit balance beneficiary account balances with adult children credit balance beneficiary account balances, particularly where the trust does not have funds and the controllers are not in a position to pay out their adult child's credit balances from their own resources? Regardless of who wins the election, and I would think the ALP is still in the box seat, the tax office has made the statement that they are going to apply 100A retrospectively, continue to apply it anyway. And their new view retrospectively. So in this sort of example where we have the parents have taken out more, the kids are left with their entitlement, perhaps we look at making a decision now to perhaps documenting that on commercial terms. That the kids, okay, they're leaving their funds behind, the parents have used it for their benefit. Perhaps we look at putting in some sort of agreement that gives the kids an extra return because of what they've done. So we've got a family or commercial dealing exception. Or perhaps we're in a situation where we look to forgive or release the children's entitlements, where, for example, there is that change in circumstance, or there's a potential change in circumstance. That may be the trigger for us to forgive that because we're concerned about a family law claim and we've got evidence to show that. So it's going to depend on the circumstances, of course, but probably some steps should be taken to try and bolster that scenario a little bit. Are testamentary trusts captured by Section 100A? Yes. Any discretionary trust, and mostly testamentary trusts are discretionary trusts, are potentially caught by Section 100A. So that is, again, something that needs to be considered in testamentary trusts, and we've got a few other questions as well in relation to that, or at least one I can think of. If a trust distributes to an adult child and then a loan gift-back arrangement is entered into between the adult child and the primary beneficiary of the trust, let's say adult child's father, does this avoid Section 100A? No. I think that actually puts you in a worse position if you're documenting that I mentioned before to try to avoid the regularity, where in this sort of scenario, if you're doing this year after year, where we have the distribution, then a loan or a gift back arrangement between the adult and the primary beneficiary. Let's return to our elements of 100A. We need an arrangement or an agreement. I'd say even after the first year, we're definitely going to have that if this happens year after year. Somebody's made presently entitled, child, somebody else benefits, parent, and it's for the purpose of tax avoidance. Well, we're paying less tax because we're distributing to the child. So we've got each of those 4 elements. We've then got to rely on the family commercial dealing exception. And I think in this sort of example, it would be more difficult to make that argument where we have that repetition, where it's hard to show the ordinary family or commercial dealing that relates to this. And as I said before, in terms of that kind of keep it simple, stupid concept, if we just distributed to the child and we hadn't entered into the gift and the loan back period, we're in a stronger position to make our arguments that it's ordinary family commercial dealing. So yeah, this is not an example that I would recommend. Taxpayers and tax agents required to adhere to the Commissioner's view outlined in draft taxation ruling regarding section 100A, or are there any cases or legislation that can be relied on for forming an alternate view? This is my opportunity to channel a little bit of a former mentor. I can never do him justice. We all need to remember that the tax office and the Commissioner does not make the law. The legislature, so the government, make the law. The courts interpret it. But what the Commissioner does is they put out their interpretation of the way they think the law applies. So there's no requirement for anybody to follow what the Commissioner's view is in any sort of ruling, in a strict sense, because that's their view. You may have an alternate view, or somebody else may have an alternate view. So the only thing that following the view, I guess you'd say, does is that potentially it protects you in circumstances from penalties and interest, or the client. But we do need to remember that's a key point. They don't make the law. They put out their views. That doesn't make it the law. They may pretend in audit situations that that is the law, but many times in the past they've been proven wrong. In terms of cases or legislation that can be relied on for forming an alternate view, I think Guardian's a great one currently. Wait and see what happens on appeal with that. But if you do anything from today, if you haven't read Guardian, go and read it. Read the sort of factual things that they put in there, the sort of basis that they built to make sure that they could have that argument. Yeah, thanks for that question. It is always important to remember the Commissioner doesn't make the law. What is your view on retaining distributions to adult children who have no control or management responsibilities in the ultimate business in the trust, with the intention of paying them out in 4 to 5 years' time when they purchase a house or need funding? The benefits of retaining it in the trust would be a higher rate of return than bank interest or funding working capital in the business. The ATO has suggested this is a blue zone risk, but glad of your thoughts. Look, I think that's actually a really good factual scenario / argument that you could raise, where you have this intention, and clearly you've got to have more than just, well, this was our intention. You've got to have some evidence that this is why you did it at the time. But that, to me, that's classic ordinary family dealing. We're increasing our wealth now so that in 4 to 5 years' time, we can help out the children for funding. So the ATO may put it in a blue zone, but I think that's really what you're looking to sort of have as your evidence to show why it's ordinary family dealing, if you have to rely on that. Of course, you have to follow what you say, and if you're saying that in 4 to 5 years' time we're going to help them with a house or funding, you need to do that. If you don't do it, you need to show the reason that you didn't, and that may be a downturn in market or interest rate rise. But you do need to make sure that you do follow what you say, if that's what you say the plan is. I have a client with a discretionary trust who has distributed income to their elderly parent each year. The funds are not paid to the elderly parent and instead retained in the family trust and invested. No beneficiaries of loans. The elderly parent, as part of their ordinary family dealings, has offered to fund the granddaughter's school fees from the unpaid present entitlements in the discretionary trust. Do you believe paying the school fees from the unpaid present entitlement falls foul of the ATO's position? Further, it has been determined that the parent's unpaid present entitlement should be retained in the discretionary trust so that it can be used to assist with any future needs requirements that may arise, e.g. home care, nursing. Look, again, I think that is a strong factual scenario where you'd be looking at ordinary family dealings. It's not uncommon, very common for grandparents where they can afford to do it to want to help out by paying grandchildren's school fees. With that, if you think about it, I guess conceptually, if you have actually paid it to the grandparents, as in cash flowed it to the grandparents, and then they paid the school fees from there, you wouldn't really have any issue with that from a 100A perspective, because you actually paid it. The beneficiaries receive the funds. Then they've chosen, as part of ordinary family life, to fund or pay for the grandchildren's school fees. The fact that you haven't paid it and it's been paid directly from the trust, I think, is just skipping that step of physically paying it to the grandparents. And clearly, I'm not an accountant, but I would assume there's going to have to be a reduction in their entitlement as the payments are made. But again, I think it's a great example of what you consider to be ordinary family dealing. And furthermore, that further comment about being determined that in the future it can be used to help the grandparents. Again, coming back to that scenario of why are we doing this? Well, we're doing this so that in the future we can, as a family, we can help each other. So again, I think that's a great example, and thanks to the person that submitted that. For the purpose of using the ordinary family dealing exclusion, what sort of documentation would be necessary? Are the trust distribution minutes enough? Unless you've got very lengthy trust distribution minutes, which explain your reason for doing things, and it's rare to see those. I think it's not going to be enough. As I said, I think you're going to need, if we were to return to that slide of building the case, we're going to need sort of our file notes, our email exchanges. If we go to the extent of getting some sort of a statement of advice, all of those sorts of things are going to bolster our case. Trust distribution minutes on their own, unless they are very detailed, are not going to be enough. And 99 of the 100 trust distribution minutes I see simply say, here's the income, goes to A, B, and C. So that in itself is clearly not going to be enough. I'm assuming that the most appropriate solution is to move the distribution through the trust and put it into family loan agreements to avoid the need for the beneficiary to be part of the management of the trust. The loan agreement can provide for repayment of the loan, applying reasonable board and other specific expenditure unpaid on behalf of the adult child. What is the appropriate term for the principal repayment of the loan? Interest-free is 10 years. Can the family loan be longer than 10 years? What future circumstances may allow for the adult beneficiary to gift that money back to the parents? Obviously, independent action. Not linked to distribution, such as overseas travel for work, change in family status. So I guess in terms of the first part, yeah, that is a strategy we could look to implement where we actually pay the funds through and then we have a loan agreement on commercial terms. And that's probably going to be the sticky point because that is an exception if it's commercial dealing. The question is going to be, what is those sorts of commercial terms? And I think you'd have to look at really what you would get elsewhere in the market and at least replicate that. So in terms of time period and interest, I think that's really where you're going to have to tie in that. I guess probably the easiest analogy would be to look at sort of like the arm's length provisions within super, the sorts of examples that are given there. But I think you still need to have some, well, you have to have commercial terms in the loan agreement for you to be able to rely on that exception. The second point, in the future circumstance, I think that they're good examples in terms of why you would want to gift the money back at that stage. Particularly family status, de facto relationship. Other things may be identifying a drug or a gambling issue, mental health issues, obviously not too bad mental health issues, otherwise they probably don't have the capacity to gift the money back. But those are the sorts of things that you would look at, where if you're going to take the step of gifting money back or releasing the entitlement, it's good to have those obviously separate independent actions. So it's difficult for the tax office to say that the agreement was that the child would be made entitled on the basis that they would gift it back at a future time. If we can show a different action caused us to consider that, then that's certainly going to strengthen that. And that was really part of Guardian as well, in terms of that separate events causing us to do something else. So again, I think the second point, yeah, certainly, definitely, when we're looking at that, that's part of the sort of extra evidence that we'd want to see. How will the rules apply to distributions made to minors from a testamentary trust where the parents use the money to pay the kids' school fees, holidays, which would be the normal expenses of bringing up children? Again, technically, 100A would apply to, or could potentially apply to, those sorts of distributions. Again, I think you're coming back to your arguments in terms of saying this is ordinary family dealing. The fact that a testamentary trust is taxed differently, it is not, in my view, tax benefit in itself. It's a function of the legislation. So the fact that because we distribute to the children from the testamentary trust, they are treated as adults, the analysis is really the same. Because, well, when I say analysis, the analysis to a normal discretionary trust where we're distributing to adult children, what's our objective? Why are we doing it? If it's to pay those sorts of fees and those sorts of things, again, I would say that is ordinary family dealing. From a practice standpoint, are there any suggestions to existing policies, guidelines, processes that should be revisited? If so, what could the focus be in the context of year-end tax planning, trust resolutions? I think I've pretty much covered that, so I won't go back into it, but obviously, yeah, making sure that we've got more evidence of what our family goals are and our family plans and why we're doing this. Does it matter whether the distributions remain as unpaid entitlements in the accounts when assessing whether 100A applies, or the dealings are ordinary family or commercial dealings? For example, trust distributes to business owner and relatives. Business owner takes a loan from the trust in excess of their entitlements. Other beneficiaries have not yet received payment for the entitlements. Strictly speaking, it doesn't matter whether they are left as unpaid. Whether they're paid or unpaid, 100A could apply, because if we return back to the provision, we've had an arrangement, somebody's been made presently entitled, someone else has received a benefit, and there's a tax avoidance purpose. So it doesn't need to be left unpaid for 100A to apply. And so it's a consideration whether we leave it unpaid or whether we pay it. And what I mean by that second one is that sort of scenario where we pay it and then the money automatically comes back into the trust. So again, it's something that we'll need to consider. In your view, would the distribution of dividends via a trust to relatives, e.g. parents or adult children, which are applied as Division 7A loan repayments, constitute ordinary family or commercial dealings? Yes. I guess very simplistically, how else are they going to fund the repayments? So I think that would, yeah, I'm not going to dwell on that further, apart from saying, yes, I'd take the view that's ordinary family or commercial dealings. I'm conscious of time. I think there's only one more question slide. I've seen a few questions pop up during the presentation. See how we go, but in terms of the last of the slides here, is accrued family wealth inside or outside the trust, which might ultimately transfer to the beneficiaries in satisfaction of the entitlements upon death or vesting in the trust, be regarded as ordinary family or commercial dealings? Realistically, I think that question has pretty much hit the nail on the head in terms of the sorts of arguments that we're going to be wanting to build our case for. As I said, we're accruing the family wealth for the benefit of not this generation, but also the generation after and after that. You can't say that is in ordinary family or commercial dealing. I would say that's very ordinary family or commercial dealing. You know, as I said, the historical concept of each generation wants the next generation to be better. So definitely. And I think that's really where we've got to start couching our documentation and our arguments. Kim, have you had a chance to just run through the questions to see which ones I've already answered or not answered?
Yep, so we've got a couple here that haven't been answered. So the first one is, With respect to trust distributions and UPEs to bucket companies, do the ATO's new approach to the timing apply to ordinary UPE loan arrangements, i.e. where a sub-trust isn't used?
Just put myself on mute, so I was finding my unmute. There's not so much a 100A issue, but there are some differences in timing for the Commissioner's new view on Division 7A. It escapes me at the moment in terms of it, but it depends on whether there's a sub-trust or a loan agreement put in place. I mean, in essence, you still have that kind of time delay there, but we covered that in a separate session. So if you wanted a more definitive answer, if you go back to our earlier session, which covers off Division 7A, then it will be in that.
The next question is a question regarding distributions to a lost trust. If the trust has distributed to a lost trust in the past and has ticked all the boxes with family trust selections, can we not now distribute to the lost trust in the future?
Well, yes. So just because the Commissioner has brought up 100A again doesn't change our normal sorts of ability to distribute to lost trusts. I guess the scenario or the question is going to be, well, how is that part of the ordinary family group or commercial dealing? Certainly if we're interposing lost trusts from elsewhere or we're finding them elsewhere, that's going to be an issue. But where it is legitimately a trust that has been used within the family group and it has losses in it, I don't see any issues with continuing to distribute to it. As the question of the person who put in the question said, you've got to do family trust elections, those sorts of things, interposed entity elections, but 100A of itself, unless it is something, as I said, where you're kind of interposing that lost trust, the same sorts of, I wouldn't have any issues with that. Because I guess, sorry, Kim, I guess the sort of counter question is, well, can we never use lost trusts or lost entities again? And clearly there are integrity provisions for lost trusts and losses. As long as we're meeting those, then there's no reason why we can't continue to use them.
We've got two more questions. This next one is, if a trust is purely an investment trust and each year no cash is paid out to any beneficiary, but invested again in the trust, is it a Section 100A issue?
We need to consider 100A, obviously, but again, what's our reason for doing this? It's an investment trust. We're building wealth. We're building it for the family, presumably. I would say that's why we're going to be relying on ordinary family and commercial dealing.
Great, thank you. We've got the last one, which is where to from here? It appears to be safe. The distribution, to be safe, it appears that the distribution must be either cash flowed or used to pay beneficiary expenses from the trust.
Where to from here? Tax Office put out these sorts of material to try and modify taxpayer and tax agent behaviour. In terms of what to do, it's a bit difficult to answer because, every client is going to be different and every client has different circumstances. So your choices realistically are continuing to do what you've always done and make sure you're building up that evidence in terms of the ordinary family commercial dealing carve-out. Not do it anymore, or move out of a trust to another structure. So it is something that will depend on the client's circumstances. So unfortunately, there's no one size fits all.
We had one last minute question come through, which is, what is the position of past distributions to adult children, but funds were not paid to them? The accounts of the trust show that these amounts have been offset and credited to the parent's loan account. Yeah,
so that's really I guess a classic 100A risk. It's historical, of course, but 100A doesn't have an amendment period, so there's a risk there. Again, returning to the scenario that, well, okay, we've got a 100A risk. What's our argument against it? And that's where we're going to be returning to our carve-outs. And I feel like I've repeated myself a couple of times, but without trying to repeat myself too many times, looking to why are they doing it? What's our family reason for doing it this way? So yeah, it identify the risk. What can we do to, if anything, to mitigate that risk? As I said, don't go back and recreate things that didn't happen, but certainly have a look at, well, why was this done? What's the overall plan for the family?
All right, so that's all of the questions. So thank you, Adrian. Just a reminder for everyone in attendance that we'll send out a feedback email shortly. If you want to complete that, that would be great. And if there's any topics that you'd like to hear from us, please pop it in there and send it along. We do look forward to seeing everyone at our next webinar or in person. And thanks again for attending. We'll close it off now.